one of the things that's worth kind of being careful of in say the Bitcoin space is hero worship. Bitcoin is one where, the majority of the world can access it, right? So not everyone can access stocks, especially in emerging markets, right? But anyone with a smartphone, which is something like 4 billion people now, can access Bitcoin. And so some of the most inflationary effects are not even in developed countries. And so right now the lowest areas of inflation are in places like Europe or Japan. Then you have higher inflation in the United States because we increased our money supply at a faster rate. But then when you go out into a number of emerging markets, they have higher levels of inflation, and those are environments where, I think that there's a much easier case even for holding Bitcoin. I think the case is really good in developed markets. But for example, if I was in Turkey, if I was in Argentina, if I was in Brazil, if I was in any number of these countries, as volatile as Bitcoin is, it's more attractive than holding large amounts of the local currency. And so I do think that that these forces will be continually, beneficial for the protocol over the next, 5-10 years. Most people should not be professional traders, whether it's crypto or whether it's traditional assets like stocks and bonds. And so generally the best approach is dollar cost averaging over time. Now the difference between something like an S&P 500 and Bitcoin is that Bitcoin's a single asset. You're betting on the adoption of this specific network. And so, for example, I'm generally not one of the people that argues that people should put 100% of their net worth in Bitcoin or other
Me either.
cryptos. But as a slice, maybe owning their own home, maybe having an equity portfolio, maybe having some commodity investments, whatever they are knowledgeable in or bullish on. I think that dollar cost averaging into something like Bitcoin, in addition to those other slices, can be an important part of, say, a long-term strategy, as long as they're continuing, to be bullish on that network.
You think that we have an inevitable black swan event coming at some point again because they haven't learned their lesson and are basically repeating the same behaviors of the past? Or can stocks really just kind of always go up and they can continue this path?
There's a couple factors. So one is, I think 2020, as you point out, was a good black swan because it shows, you know, not only what a say a pandemic can do, but it's also specifically what any sort of disruption can do to a system that's this highly levered. And so it wasn't specifically necessarily the pandemic that caused a lot of what we saw. It's that people had so much debt, companies had so much debt, and basically, so any disruption to cash flows results in rather quick insolvency. In addition, because the United States has run structural trade deficits for so long, we built up a deeply negative net international investment position, meaning that the foreign sector owns more U.S. assets than Americans own of foreign assets. And that includes, for example, the foreign sector owning a large amount of treasuries. And so when there was a dollar shortage during that period in March, the foreign sector had to sell some of their U.S. assets, including treasuries, in order to get dollars. And so what we saw, for example, was the treasury market became illiquid. It literally broke. And so it's funny for anyone watching. I mean, basically, it's one of the most liquid markets in the world, one of the deepest markets, one of the most kind of safe markets. And there's essentially massive bid-ask spreads in that market. It basically was essentially a broken market. And so the Federal Reserve had to come in and buy $1 trillion worth of treasuries with new bank reserves in a 3-week period. And then they slowed it down after that. But basically, they had to reliquify the treasury market. And so that shows an example of kind of how these systemic things have built up. We have such high debt levels. We have such large kind of dislocations in net international investment positions that these sort of disruptions can result in kind of, the requirements for massive, kind of responses. And so overall, there's a couple kind of tail risks that could end this. So one is this whole kind of post 2008 period of basically constantly increasing central bank balance sheets, of running these sort of policies, is that we've been in generally a commodity bear market for this whole time. And so for anyone familiar with the commodity market, you go in big cycles, right? So there's too much supply brought online, so you get a crash, and then eventually there's not enough people investing in the space, and so eventually demand catches up to supply. Prices go up, more people come into the space, but then they overbuild and it kills the price. And so from the early 2000s up till 2008, we were in a pretty strong commodity bull market. And And so that when we had the global financial crisis, that kind of damaged the oil market. It rebounded a little bit for a while. Copper kind of hit a peak, I believe, in like 2012 back then. So it was a little bit later. There's kind of the China's growth rate started to kind of slow down after that, and so that kind of resulted in a weaker commodity environment. And so ever since those few years, especially since 2012 for copper, especially since oil kind of fell off a cliff in 2014, we've been in a weaker commodity environment. And so that's actually been a pretty strong deflationary force that has allowed for a lot of this kind of money printing to occur. Now, if you were to try the same thing in a decade where commodity markets are a lot more tight, well, you could quickly kind of run into more stagflationary problems, or have inflation running hot. Even different ways of measuring it. Even if you kind of measure it in a way that's not perfect, it's enough inflation that even those metrics are showing pretty high inflation, like we're seeing now with say 5% year-over-year prints. And so if we get into an environment where oil prices are going up, and these commodity prices are kind of persistently high, that could put a check on the ability of these central banks to continue what they've been doing. And so that could push down valuations of, say, growth stocks, for example, right? Because part of why growth stocks are so highly valued is because inflation and interest rates have been pretty low for a long time. And so you can pay a pretty low, you can factor in a pretty low discount rate when you're kind of looking out at these long-term cash flows of these growth stocks. And so I think that some of the tail risks for currency devaluation would be a stronger commodity bull market, and especially some of these countries that are reliant on importing commodities, or like in the United States case, we're very reliant on importing manufactured goods. And so I think that you can have some pretty big currency dislocations when you have, persistently 3, 4, 5% inflation while you're trying to hold interest rates at zero. And so I think that we are due for ongoing currency devaluation.